Warren Buffett's value investing principles. How to assess a company's intrinsic value. This video series took 720 hours and 1 month to produce, truly enlightening. In this video, I will guide you through a breakdown of the essays of Warren Buffett, providing a deep understanding of the investment philosophy and thinking of the legendary investor. This is not just an investment book. It's also a treasure trove of knowledge about success, finance, and mindset. If you aspire to shift from pursuing wealth to controlling wealth, this book will be key to achieving your goals. Hello everyone, welcome to today's video. In the previous chapter, we explored Buffett's investment philosophy and his long-term vision concept. Today, we will delve into Buffett's value investing principles, how he assesses a company's intrinsic value, and how he applies these principles to his investment decisions. 1. What is intrinsic value? In Buffett's investment world, intrinsic value is a core concept. Simply put, intrinsic value refers to a company's true, intrinsic economic value, not just short-term market price fluctuations. Warren Buffett defines intrinsic value as the present value of a company's future, sustainable cash flows, representing the wealth the company can potentially create for its shareholders. This concept stems from his learning experience with Benjamin Graham, Buffett's mentor and one of the founders of value investing. Graham emphasized that by assessing a company's financial health and market position, investors can find companies that are undervalued by the market. Buffett further developed this theory. He is not content with simply finding stocks whose market price is lower than their true value, but focuses more on assessing the sustainability of a company's future cash flows and its growth potential. 2. How Buffett assesses a company's intrinsic value. Buffett employs a very rigorous analytical method when assessing a company's intrinsic value. He judges whether a company is worth investing in based on several key aspects. Cash flow sustainability. Buffett highly values a company's cash flow because it represents the wealth the company can potentially create in the future. He tends to invest in companies that can consistently generate stable cash flows, especially those that dominate their industry. Business sustainability. Beyond current profitability, Buffett considers a company's ability to maintain its market competitiveness in the future. This includes factors such as brand value, technological innovation capabilities, and market share. Management quality. Buffett understands that the success of any company depends on an excellent management team. An efficient and visionary management team can bring long-term, stable returns to the company. Therefore, when assessing a company's intrinsic value, Buffett pays particular attention to the competence and integrity of its management. Economic moat. Buffett mentions the concept of an economic moat, which refers to a company's long-term competitive advantage that enables it to withstand external competition and maintain its market position. And profitability. Buffett prefers companies with deep moats because they can continuously create value for shareholders. 3. Why is intrinsic value so important? Why does Buffett value intrinsic value so much? The answer lies in the irrationality and volatility of the market. Buffett often says that the stock market is like a voting machine in the short term, but a weighing machine in the long term. This means that the stock market is influenced by various emotions and market factors in the short term, leading to fluctuations in stock prices. However, in the long run, stock prices will eventually converge towards the intrinsic value of a company. This view emphasizes the importance of long-term investing. For Buffett, short-term market fluctuations are not important. He focuses on whether a company can continuously create value over the next few decades. This is why Buffett has consistently adhered to a buy and hold investment strategy, and his success proves its effectiveness. For how Buffett calculates intrinsic value, a simple approach. Buffett does not rely on complex financial models or difficult mathematical formulas. He prefers to use simple and direct methods to calculate a company's intrinsic value. He Here is one method Buffett uses to assess intrinsic value. Discounted cash flow (DCF). Buffett's most frequently used method for calculating a company's intrinsic value is the discounted cash flow method. This method is based on the company's future cash flows and then uses an appropriate discount rate to discount these cash flows to their present value. The final result is the company's intrinsic present value. Calculating expected annual earnings, Buffett predicts a company's earnings growth over the next few years by analyzing its past financial performance and industry trends. If a company can maintain stable growth over the next few years, its intrinsic value will increase accordingly. Price versus value comparison. After assessing a company's intrinsic value, Buffett compares it to its current market price. If the market price is lower than the intrinsic value, the company becomes a value investment target in his eyes. Conversely, if the market price is higher than the intrinsic value, Buffett will avoid investing even if the company performs well in the short term. 5 of Buffett's classic investment cases: Coca-Cola and Gillette. One of Buffett's most famous investment cases is his investment in Coca-Cola and Gillette. Coca-Cola. Buffett believes that Coca-Cola is a company with a very strong economic moat. It not only has a huge brand influence in the global market, but its beverage products also have extremely high customer loyalty. By holding Coca-Cola stock, Buffett not only earned substantial dividend income, but also benefited from the company's sustained growth. Gillette. Gillette's razors are virtually unmatched in the market, becoming the gold standard for everyday consumer goods. Buffett reaped substantial returns from investing in Gillette and witnessed how Gillette maintained its leading position in a highly competitive market through its strong brand and product advantages. These two cases demonstrate how Buffett selects high-quality companies that can deliver sustainable returns by assessing intrinsic value and analyzing long-term potential. 6th conclusion: the wisdom of value investing and Buffett's success. Through today's analysis, we can see that Buffett's investment philosophy is not solely based on short-term market fluctuations, but focuses more on the intrinsic value and long-term growth potential of companies. He remains unmoved by short-term price fluctuations, focusing on high-quality companies that are undervalued by the market and holding them for the long term to obtain sustainable returns. Today's stock market environment is unpredictable, but Buffett's value investing philosophy remains an effective path to success. If you can understand and practice this philosophy, you too can find your own path to success in the complex world of investing. Thank you for watching. I hope you gained something from today's sharing. If you enjoyed our content, please remember to like and subscribe. In the next episode, we will continue to explore more of the essence of Buffett's investment philosophy. Stay tuned.